Okay, everyone. Sorry about that. So, as promised, we are going to do an update. We are going to read the story of the market right now, and the story of the market is always told in the same manner, the same tone. What you're looking for is you're looking for big feet print. So, areas that we can say most likely with a very high probability is either very big institutional trading, or it's large groups of people, such as trend followers, that are coming in and placing trades. What we're looking for is where the groups are and where they're buying and where they're selling. The reason that's important to the story of the market is really simple. You want to buy low and sell high. And you also need to have an idea of how a market moves so that you have the most knowledge. You don't feel caught off guard, because as we talk about all the time, the story of the market is like the story of any good book. It is meant to have protagonists and antagonists. It's meant to get your emotions very high, very elevated. The emotions that are used here are primarily fear and greed. Now I'm obviously simplifying those emotions down to their most exaggerated form, but you could call it fear of missing out is greed, right? Or the fear emotion is just, oh no, what if the market doesn't come back? I'm going to lose more money. I won't be able to retire on time. I won't be able to buy the new house. I won't be able to buy the car. The kids aren't going to go to college on time. This is the fear I'm talking about. So let's start reading here. As you see, what I've done is I've just taken some blue rectangles, and those blue rectangles are they are surrounding areas that trading activity is very high. Trading activity is signified on a chart or in the book of the market by volume. So when you have very outrageous volume, large amounts of volume, large amounts of trading activity, learn to interchange those words, volume and trading activity. As you see those large amounts of volume or large amounts of trading activity, that tells you that institutions, the guys that make the big feet print, you can call them whatever you want. I'll use the term strong hands a lot. I'll use the term big money a lot. I'll use the term institutional money a lot. These are all interchangeable. And what they're meant to signify is just the groups of people that are in control of the market, where they're buying and where they're selling. And as you can see by these blue rectangles that I drew around the spots that I thought had the most trading activity, the spots that just point out to the normal person's eye. A normal person can see this and would have drawn these rectangles in the exact same places. Where you'll find those rectangles, if you look, is after a price drop. So look at this. So our first one is after a price drop. Now you'll say, well, Derek, there's large trading here. That's right. There's large trading at the high. There's large trading at a high. What do we talk about, or what do we talk about all the time when it comes to behavior? There can be large trading at high prices as well, because that's selling. That is the selling of this same big, strong hands, institutional traders, big money, call them what you want. Now, there doesn't always have to be selling at the highs. Sometimes what big institutions do is they simply stop buying. They just stop buying. So there doesn't always have to be a lot of buying at the highs. Now, that is something that I get into in my system, right? The mentorship, the Derek's VIP mentorship program that I utilize, that focuses on your financial plan first, then your investment plan, and then receiving my newsletter, which continually gives you my insight. It would give you insight like I'm about to give you today. I'm adding a lot of story to this because those of you that don't work with me, they're not students of mine, you've never been taught by me, I want you to understand what we're going through here. So as we look at the next large piece of trading activity, once again, as you'll notice, it's on a price drop. What this tells you when you start to see very large trading activity, a lot of trading activity after a price drop, is prices are going to go higher. And as you'll notice, you can find a few other places along the path, but I will assure you that they are always after prices have fallen, not at high prices, until you get into right here. This rectangle, this third rectangle I drew, you'll see a giant piece of trading activity that I am tracing over right now, or volume, if you will, and it is at a high price. And what does it lead to? A very substantial drop until you see trading activity, aka volume, picking up again down at the bottom after the price has fallen. So then the market, of course, begins to bounce. And as you'll see, the market will pull back, and usually it will pull back into that range, into that low area of price. They want to see if there's more that can be purchased. Are there more sellers at these levels? And as you can see, there were more sellers at these levels, but far less than there were previously. So price simply takes off. Now, we head into today because what this is about is what is going on right now. What I want you to see is what's occurring right now. This is us right now live. As I'm speaking, this is occurring. So we are looking at a weekly chart. We're going to zoom into a daily chart here. This is going to zoom in for us a little closer as to what we're looking at in the moment. And if we really want to zoom in, I can go ahead and stretch this chart out so you can really have a good look. And let me show you something that should be extremely obvious to anyone. Prices fell up here at the top. Look, they fell. We had volume pick up, but I wouldn't say this is volume that necessarily stands out. If you look back here, here's some, 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 here's some. It's pretty standard. I would say your average volume level, if I were going to draw average volume onto this chart, onto this story, I would say this is probably somewhere around average volume right there. Okay, but what is so interesting about what's going on right now is this. We have this large volume, which we expect. It's not large volume, but it's higher than the average, okay? And we have it at a low price. But as prices are rising right now, so as we have prices rising and approaching a previous high, what do we have volume doing? It's fallen off the map. Now, we just covered this very, very briefly, but let me tell you that when you see something like this, what you are looking at is a lack of interest of purchasers at that price, meaning where the NASDAQ stands now and where the stocks in the NASDAQ stand now, there is no interest in purchasing at those prices, okay? There's just the interest has dried up. And what did we just discuss 1 minute ago? When you get to higher prices, two things can happen. One, you can have massive activity, and that is traditionally selling, or activity can dry up, which simply means there's no more buyers. But both lead to the same thing. Both lead to a drop in prices. Now, for those of you that don't follow me, you're not students of mine, you've never worked with me before, and this is information that you get from me when we work together. And I'll bring this stuff out from time to time, but traditionally you're not going to see a lot of this in my regular post. But let me zoom in a little bit and show you. So now what we know is buyers have dried up. That means that there's still a desire to buy more. So in a long-term time frame at this point right now, you have to be a buyer. You have to be bullish. But what you know with a lack of buyers is that price needs to pull back down. Price needs to pull back down to see if there's enough buying at these lower prices to push back to a higher price. So can we go higher, or is it in the cards to go higher? And let me show you where prices will come back to. Prices. Oop. I didn't mean to pull the whole screen. Let me put that back. Prices are going to come back right here to this area. Now, those of you that follow me know why. And for those of you that don't, basically what you look for in indexes are gaps in the chart. So a gap is a place that prices were pushed through by institutional money or big money. And when you get into a situation like we're in now, where volume is drying up, and you can even see volume drying up on this 1 hour chart, when you get into an area like this where volume is drying up, prices will traditionally return to the area that price was pushed through. So this big gap means that prices didn't go through that price on their own. They were pushed there in overnight trading. So what we'll be looking for as prices decrease as an area somewhere around 425 on QQQ is an area to purchase. Now, this is just a piece of what I do, and I hope you enjoyed it. I'm covering the Qs here. I'm going to quickly run through the S&P 500. I do that through SPY because I like the way the volume shows up a lot better than I do just going to the traditional index of SPX. You can do either or, and it'll work the same way, and you'll have the same chart patterns. There's absolutely no difference. I just prefer the ETF. It shows me a little more of what the strong hands are doing versus the weak hands, institutional buyers versus retail buyers. So I hope you enjoyed that with the Qs. So remember, we're seeing a lack of buying right now at these prices. Volume has dried up, and we should see a return to 425. And from there, we would know whether or not we should be buying and maintain a bullish stance, or whether or not we should be looking at selling. But for now, your short-term target's right there at 425. It's 20 points below where we are now, just about 4%, maybe 5%. So for you short-term traders, that's my opinion. That is my process. That's what I do, and that's what I see. For you longer-term investors, what this tells you is, hey, if I start to see a 4 or 5%, decline in price, and I have some cash that I'm looking to put into the market, if I've properly managed my cash, if I have good cash management, this might be a time to put 2 or 3% more into the market. All right, let's take a look at the S&P 500. We're going to do what we just did again, because we always start from big picture and we always zoom in. So we're going back to a weekly chart. We're going to go ahead and change this over to the S&P. And here we are, once again, approaching high prices. We're approaching the previous high price. If you look on the S&P, you won't see as many standouts in volume, will you? That is because the leader of this particular market is the NASDAQ. The NASDAQ is the leader. Now, if you follow me and you're my student and you subscribe to my newsletter, you are already well aware of what that being the leader means, and you're well aware of why it is a better place to have your money. You always want to have your money with a leader. The leader is always telling you what's going on. Right now, the S&P is the follower. I can tell you there was a time in 2008, 2009 where these roles were reversed, and I only cared about the S&P. I wasn't even looking at the NASDAQ because it was the market that was lagging. It was not the leader. It was the laggers. So right now, the S&P is being pulled along by the NASDAQ. So I will always look at the NASDAQ first. Of course, we are seeing the same story told. If we look here, I just outlined some areas of what you would call increased volume. Looks nothing like the NASDAQ, as I mentioned, because it is not the leader. But look at the volume right now. It is drying up. That means prices are not interesting to the current purchasers of the S&P, the people that are trading within the S&P 500. So let's go ahead and remove that. That tells the same story in the long term. Let's go ahead and look at it on a daily chart. We look at a daily chart and we see basically the same thing we saw as the NASDAQ. There's no standouts in volume. There's no big, massive behavior going, which leads us to believe there's no massive turn of events coming. It doesn't lead us to believe we're heading into a bear market, although it's possible. However, for now, it doesn't appear as though it is. We see volume declining as prices are rising. All right, so we see that there. So let's zoom in a little bit more. That picture tells us basically the same thing the NASDAQ does, which makes perfect sense because the NASDAQ is our leader. So let's go ahead and zoom into a 1 hour chart and see if we have the same. And there we go. We have the same gapping feature. Why do we have the same gapping feature, everybody? Say it in unison. Because the NASDAQ is the leader, Derek, and the leader leads, and the S&P is your follower. The S&P being the follower is going to have similar gaps. The S&P also does one other thing for us. It is showing us that we have two stops in our little trip downward. And here they are. Well, let me get that. Here are our two stops. So ultimately on the S&P, we are going to look for prices to come down here somewhere about 503, 500. Probably we will have a little stop off at about 510. Now, the thing to realize is if the S&P is going to have these stops, odds are the NASDAQ is going to have the same stops. I think I've given you plenty of information. I think it should make perfect sense to you. If you do have any questions, please reach out, shoot me a direct message. I do one-on-one training. I also have my VIP 6-week mentorship course starting here in a couple weeks that I will be doing. We will go through financial planning. We will go through investment planning, investment management. That's cash management, investment management, and risk management. I will show you how to do this for yourself. Once you complete that mentorship course, then you sign up for my weekly newsletter. And usually I do, it's usually bi-weekly. It's a video series. And it's written, and you can read what I'm seeing in the markets. Again, everybody, this is education, not advice. I'm educating you on what I see and how I see it. And what we're really looking at here, folks, is emotions, believe it or not. We are simply reading the book the market is giving to us, and we're reading the emotions of the people involved. Right now, if you're an institutional investor, if you're big money, if you're the strong hands, you're just apathetic. You're like, whoopity-doo-dah. These prices aren't attractive. Don't care. Not buying. And what we'll look for is for them to pull down and get excited again. There has been no selling. There's been no institutional selling off to the so-called weak hands or retail or smaller self-directed traders. They haven't sold off to them. So right now we're not in fear of a big correction or a recession. All right. I hope you enjoyed that. Thank you for watching. Any questions, please go ahead and ask me. DM me, send me a comment, like and subscribe, follow me, all of that good stuff. If you're interested in my VIP mentorship program that's starting in a couple of weeks, 6 weeks, I cannot encourage it enough. Please reach out to me, and I look forward to seeing you then. I will be live at 4 p.m. Pacific Daylight Time. I am going to go over, well, I'm not exactly sure what I'm going to go over today. I talked about cash management this morning. I think I'm going to cover a little bit more about the emotions attached to cash management and why we need to control our cash so well. But I'm probably going to touch base on a few market activities going on. I see GameStop having some activity. I see Space SPCE having some activity. So I'm going to touch on a few things. In any case, I will see you at 4 o'clock Pacific Daylight Time. That is 7 o'clock Eastern Standard Time. And that is 2 in the morning for my new friend Nikolai in Latvia and for any of you in London.